Silver just closed the week at a critical threshold. And then, within hours, everything changed. A tanker was struck, a warning was issued, and the man who once said, "We've already gone big," is now promising to go bigger. 2 days of silence follow. 2 days where the markets cannot react. 2 days where fear simply builds. By the time trading resumes, it may already be too late to prepare. What happens next could determine whether silver breaks through its ceiling or breaks down entirely. Stay until the end, because what's coming Monday will not wait for anyone. Welcome back to Precious Metals Intelligence, the channel built for those who prefer to understand a crisis before it arrives, not after. Before we begin, take a moment and share in the comments, where in the world are you watching from today? This community spans continents, and it helps to know exactly who's preparing alongside us. Now, let's walk through exactly what happened, and what it may mean for the days ahead. On a quiet Friday afternoon, the metals market closed the way it always does. Traders logged off. Screens went dark. Most investors expected a normal weekend, followed by a normal Monday. But away from the trading floor, something else was already moving. Hours after the closing bell, new reports began to surface. A tanker had been struck in the Strait of Hormuz, one of the most important waterways in the world for global energy trade. Soon after, further warnings followed. Officials in Washington signaled that more military action against Iran could be coming. Embassies across the Middle East issued alerts, urging American citizens to leave the region. Within a single day, a normal Friday had turned into something far more serious. This is the moment analysts describe as a closed market shock. It happens when major geopolitical news breaks after trading has already stopped for the week. No buy orders, no sell orders, no price discovery, just headlines, one after another, building on top of each other while the market itself stays frozen. For most investors, this creates a strange kind of tension. They can read the news, they can feel the uncertainty rising, but they cannot act on it. Not yet. All they can do is wait and wonder what Monday will bring. This is exactly the situation the world found itself in. By Saturday, the reports had multiplied. Kuwait's military said it was responding to drone attacks. A vessel in the Strait of Hormuz was damaged. Iranian officials issued a formal warning, saying that if the pressure continued, the strait itself, and potentially other key waterways, could be closed entirely. That statement alone was enough to concern anyone watching global energy flows, because a large share of the world's oil and gas passes through that single corridor every day. By Sunday, the picture had grown even more serious. A tanker carrying liquefied natural gas was reportedly struck. Evacuation warnings expanded, and still the market remained closed. Still, no one could react. This is where silver enters the story. At the moment trading stopped on Friday, silver was sitting close to a critical price level, a point where it had struggled before, tested before, and so far failed to move decisively past. Analysts often refer to levels like this as a line in the sand. Prices tend to bounce off these levels again and again until something forces a real breakout, one way or the other. Now, that breakout pressure was building, not from the usual forces of supply and demand, but from geopolitical risk stacking up in real time while no one could trade. This matters because silver holds a unique position among commodities. It is not only viewed as a safe haven asset, the way gold often is, it is also an industrial metal used heavily in manufacturing, electronics, and energy technology. That means silver can be pulled in two directions at once. Rising fear can push investors toward it as protection. But rising energy, costs, and economic uncertainty can also weigh on industrial demand, pulling it in the opposite direction. It is this tension, safety on one side, economic risk on the other, that makes silver especially sensitive to events like the ones unfolding in the Middle East. By the time the weekend came to a close, 3 full days of escalating headlines had piled up, with no market open to absorb any of it. Analysts who study these situations closely know what tends to happen next. When uncertainty builds for this long without release, the reaction, once it comes, tends to be sharp. Prices can move quickly. Gaps can form between Friday's closing price and Monday's opening price. And the first moves, right when trading resumes, are often the most volatile of the entire week. This is the situation professionals were now watching unfold. Not a single isolated headline, but a chain of events, compounding hour after hour, with the market forced to sit in silence the entire time. And as Monday approached, one question stood above all the rest. When trading finally resumed, would silver break through the resistance it had struggled with for so long, or would the weight of uncertainty finally push it the other way? That answer was still hours away, but the forces shaping it were already firmly in motion. Few places on Earth carry as much economic weight as the Strait of Hormuz. It is narrow, it is easy to overlook on a map, and yet a large portion of the world's energy supply depends on ships passing safely through it every single day. To understand why silver, oil, and global markets react so strongly to events in this region, it helps to understand the strait itself. The Strait of Hormuz sits between Iran and the Arabian Peninsula. At its narrowest point, it is only a few miles wide. Despite its small size, it serves as the passage for a significant share of the world's oil and liquefied natural gas. Tankers moving fuel from major producing nations to markets around the globe have almost no alternative route. If this passage is blocked, delayed, or made unsafe, the effects are felt far beyond the region itself. This is why any disruption here, a strike, a threat, a warning from officials, tends to move far more than local headlines. It moves global energy prices. And when energy prices move, the effects ripple outward into nearly every other part of the economy. Analysts who study commodity markets closely have seen this pattern before. When tensions rise in this corridor, oil prices typically climb first, as buyers price in the risk of reduced supply. Natural gas often follows a similar path. From there, the effects spread into inflation expectations, shipping costs, and investor sentiment more broadly. It becomes less about one region and more about the stability of global trade itself. This is the environment silver was now sitting inside. To understand why silver reacts differently than other assets, it helps to look at what silver actually is. Unlike gold, which is used almost entirely for investment and reserves, silver serves two very different purposes at the same time. On one hand, silver functions as a monetary metal. Investors turn to it during periods of fear, uncertainty, or instability, much the way they turn to gold. When conflict escalates, when currencies weaken, when confidence in financial systems is shaken, silver tends to attract buyers seeking a store of value outside the traditional system. On the other hand, silver is also an industrial metal. It plays a critical role in manufacturing, electronics, solar technology, and a wide range of energy applications. Its price is not shaped only by fear. It is also shaped by the health of the global economy, industrial demand, and the cost of the energy needed to produce and transport goods. This dual identity is what makes silver's reaction to events like the one unfolding in the Middle East so difficult to predict. If investors respond primarily out of fear, they may rush toward silver as a safe haven, the same way they often rush toward gold. This kind of demand can push prices higher quickly, especially when uncertainty is high and confidence and stability is low. But if rising energy prices and geopolitical tension begin to weigh on the broader economy, industrial demand for silver can weaken. Higher shipping costs, disrupted trade routes, and reduced manufacturing activity can all place downward pressure on the very same metal that fear is trying to push upward. This is the balancing act analysts refer to when they describe silver as a metal caught between two forces. It is not simply reacting to fear, the way people often assume. It is absorbing two competing signals at once, one pushing it up and one pushing it down. Historically, this tension is played out again and again during periods of Middle East instability. Analysts who have tracked silver's performance during past flashpoints in this region have noted a consistent pattern. Fear alone is rarely enough to drive silver sharply higher on its own. But when fear combines with a serious threat to global energy supply, the reaction can become far more powerful and far more difficult to predict using normal market logic. This is precisely the combination now forming. A direct military threat, a critical shipping corridor under pressure, and a metal sitting at a price level it has struggled to move past before. As the story moves into its next stage, the focus shifts from what caused this moment to how investors actually behave once uncertainty like this is allowed to build without release. Because understanding market psychology, especially during a prolonged pause in trading, may be just as important as understanding the headlines themselves. Markets are not only driven by numbers, they are driven by people. And people, when left without information for too long, tend to fill the silence with something far more powerful than facts. They fill it with imagination. This is the hidden force behind what analysts call a weekend gap event. It is not simply about what happened. It is about what happens inside the minds of investors while they wait to react to what happened. When a major news event breaks during trading hours, the market absorbs it almost immediately. Prices adjust, orders are placed. Within minutes, or even seconds, a rough consensus begins to form about what the news is worth. The reaction may be sharp, but it tends to happen in a controlled, gradual way, spread across many hours of active trading. A closed market event works very differently. When the news breaks after the market has already shut for the weekend, that gradual process cannot happen. There's no mechanism to release the pressure as it builds. Instead, every investor is left alone with the same headlines, replaying the same questions, hour after hour, with no outlet to act. This is where psychology begins to take over from analysis. Behavioral researchers who study financial decision-making have long observed that uncertainty affects people differently than clear, negative news. A single bad headline can be processed and priced in, but an unresolved, ongoing situation, one that keeps evolving without a clear conclusion, tends to produce something else entirely, anxiety that compounds over time. Each new report adds another layer. A tanker is struck, then a warning is issued, then another warning follows, then evacuation notices appear. None of these events exist in isolation. Together, they form a rising sense that something larger is unfolding, something the individual investor cannot fully see or control. This is precisely the environment that developed across that weekend. Friday brought the first shock, Saturday brought confirmation and escalation, Sunday brought further developments, with still no market open to respond. By the time trading was set to resume, investors had spent nearly 3 full days absorbing risk they were powerless to act on. Analysts who study these patterns often point to a simple but important truth. Uncertainty that cannot be acted upon does not disappear. It gets stored, and when the market finally reopens, that stored uncertainty tends to be released all at once, rather than gradually. This is why the first moments of trading after a closed market shock are so closely watched by professionals. It is often not the calm, orderly price movement seen on a normal day. It can instead resemble a kind of release valve opening after days of built-up pressure, with prices moving quickly in one direction before any real stability returns. History offers useful reference points here. On multiple past occasions, when serious geopolitical developments emerged over a weekend, commodities and safe haven assets have opened the following week at levels noticeably different from where they closed. In some cases, prices moved sharply higher as fear dominated early trading. In others, initial spikes were followed by equally sharp reversals as cooler analysis began to replace the emotional reaction of the opening bell. This unpredictability is part of what makes these moments so important to understand, rather than simply react to. The first price movement is rarely the full story. It often reflects emotion more than analysis, urgency more than strategy. For long-term informed investors, this distinction matters greatly. Reacting purely to the emotion of an opening move can lead to decisions made under pressure, rather than decisions grounded in a clear understanding of the underlying situation. Professionals who have studied these patterns tend to approach such moments differently. They separate the initial emotional reaction from the deeper structural questions. What does this event actually mean for supply, demand, and long-term stability? And has the market's first reaction accurately reflected that, or simply reflected fear? As the story now moves closer to Monday itself, attention shifts toward a more practical question. With emotion running high and uncertainty fully built up, what specific signals should a careful observer actually be watching for once trading finally resumes? By the time Monday finally arrived, the waiting was over. But for careful investors, the real work was only just beginning. A sharp opening move on its own tells very little. Prices can spike in either direction within the first few minutes of trading, driven largely by emotion rather than analysis. Professionals who study these situations know that the true picture only becomes clear once the initial reaction settles and the underlying signals begin to show themselves. The first signal worth watching is the price level itself. Before the weekend's events, silver had been testing a well-known resistance point, a level it had approached before without managing to move decisively above it. Analysts often treat levels like this as a kind of battleground between buyers and sellers. If silver were to move convincingly above that level on strong volume, it could suggest that new buying pressure, driven by safe haven demand, was strong enough to overcome the metal's previous hesitation. If instead the price approached that level and failed again, it would suggest that fear alone was not enough to shift the broader trend. The second signal involves comparing silver's movement to gold's movement. Gold is widely viewed as the purest safe haven asset, reacting almost automatically to geopolitical fear. Silver, as discussed earlier, carries a more complicated identity. Because of this, watching how the two metals move relative to each other can offer useful information. If both metals rise together, and by similar amounts, it suggests the market is treating the situation primarily as a fear-driven event. If gold rises while silver lags behind or moves less, it may suggest that concerns about industrial demand and broader economic slowdown are weighing on silver, even as fear pushes gold higher. The third signal centers on energy prices. Because the entire situation originated from a threat to a key global shipping corridor, oil and natural gas prices serve as an early and direct indicator of how seriously the market is treating the risk. A sharp, sustained rise in energy prices would suggest that traders view the disruption as a real and ongoing threat to global supply. A more modest or short-lived reaction might suggest that the market expects the situation to stabilize quickly without lasting damage to the flow of energy through the region. The fourth signal is less about numbers and more about language. Statements from government officials, central banks, and international bodies often shift subtly in tone during moments like this. Analysts pay close attention not just to what is said, but how firmly it is said, and how it compares to previous statements on the same subject. A shift toward more urgent or more permanent-sounding language can signal that officials themselves expect the situation to escalate further. A softer, more measured tone may suggest that behind the scenes, expectations of a resolution are beginning to grow. Taken individually, none of these four signals tell the full story, but taken together, they begin to form a clearer picture than any single headline or price movement ever could. This is the core difference between reacting to a crisis and understanding one. Reacting means responding to the loudest headline or the sharpest price move of the moment. Understanding means stepping back, gathering multiple sources of evidence, and allowing a more complete picture to form before drawing conclusions. For business professionals, entrepreneurs, and anyone responsible for protecting capital during periods of instability, this distinction is not simply academic. It often determines the difference between a decision made in a moment of panic and a decision made with a clear, informed view of what is actually unfolding. As Monday's trading session continues to develop, and as these four signals begin to reveal themselves more clearly, one final question remains. Given everything that has now been set in motion, what does this moment actually mean for the months ahead? And how should a careful, long-term observer choose to respond?